People obsess over finding the next great stock. Almost nobody obsesses over a tiny number called fee. But here's the uncomfortable truth. Over decades, that tiny number can quietly erase a life-changing chunk of your wealth. I've watched it happen in portfolios for years. Today, I'll show you exactly how it happens and how to stop it so compounding works for you, not against you. When I say fees, I'm talking about a few buckets. First, the expense ratio, the annual fee your fund charges just to exist. Second, advisory fees, what an advisor charges to manage your money, often as a percent of assets. Third, trading costs and spreads, less visible but real. Some mutual funds also tack on sales loads or wrap fees. On a statement, each piece looks harmless. Together, they're sand in the gears of compounding. Let's make this real. Imagine you invest $300 a month for the long haul. If your money compounds at 8% a year, roughly in line with long-term stock market averages, that stream can grow to about $447,000 after 30 years and around $1,047,000 after 40 years. Now shave off just 1% for fees so your net return is 7%. After 30 years, you're at roughly $366,000, and that was only 1%. Plenty of investors pay more once you add an active fund at, say, 1% plus an advisor at 1%. Push that net return down to 6%, and the same $300 a month lands near $597,000 after 40 years, versus just over $1 million at 8%. That's roughly $450,000 left on the table. When people tell me fees don't matter, I show them these compounding gaps. They usually go quiet. Why does this happen? Compounding doesn't care whether the drag is a bear market or a line item in a prospectus. Every year the fee shaves a bit off your return. Next year you're compounding a slightly smaller base. Repeat for decades and the gap becomes a canyon. The other uncomfortable part, fees are guaranteed. Future returns are uncertain, fees come out like clockwork. So what can you actually do? Start with the big lever, the expense ratio. For your core holdings, choose broad, low-cost index funds where the ER is microscopic. Think a few hundredths of a percent. On $10,000 invested, 0.03% is $3 a year. Compare that with 1%, $100 a year on the same $10,000, and it scales with your account. You don't get a bigger office, faster phone support, or guaranteed outperformance for that extra cost. You just get less compounding. Next, look squarely at advisory fees. I'm not anti-advisor. Good advice is valuable, but how you pay matters. 1% of assets forever is expensive rent on your future. If you want planning, consider a flat fee or one-time plan. If you want automation, many robo-advisors charge about 0.25%, and if you're comfortable with a simple index fund portfolio, automating contributions and rebalancing once a year is well within reach. Then tackle trading and turnover. Funds that churn positions trigger costs and, in taxable accounts, capital gains distributions. Index funds tend to be more tax efficient because they trade less. That's not just convenient, it means fewer surprise tax bills. Keep turnover low, and you keep more of what you earn. While we're here, let's do one more piece of practical math. Plenty of glossy brochures pitch expert active funds at 1%, 1.5% ER. If that fund matches the market before fees, you still lag by the fee amount every year. To break even versus a low-cost index fund, an active manager has to outperform by more than their fee after taxes, consistently for decades. Some do in short stretches. Very few do over long horizons. Meanwhile, the low-cost index fund quietly compounds. Here's how I'd build a low-drag setup if we were sitting together mapping your plan. Pick a broad market index fund as the core, S&P 500 or total market if you are REU, S&P focused, global if you want world exposure. Verify the expense ratio is tiny and the index methodology is exactly what you think it is. Set an allocation that fits your risk, maybe 80% stocks, 20% bonds if you can handle volatility, and automate contributions the day after payday. Turn on dividend reinvestment, rebalance once a year. Don't reinvent the portfolio every headline cycle. Use the right account wrapper. In the US, 401ks and IRAs reduce tax drag. In the UK, ISAs do the same. Taxes and fees are the two levers you control on day one. Get those right and you don't have to be perfect anywhere else. What about the common objections? Aren't index funds a bubble because everyone buys them? No. The prices inside an index are still set by active buyers and sellers trading individual companies all day. Index funds ride that price discovery. But I'll miss the next Amazon. You'll own it as it becomes a leader. You won't have to guess which seed will sprout. My advisor says their process adds value. It might, so ask to see net, after fee, after tax results over full cycles. If the value is real, it will survive that filter. If you only remember one picture from today, make it a bucket with a tiny hole. That hole is your fee. At first, the leak looks harmless. Decades later, the bucket that should be full is noticeably lighter. You can't control the rain, but you can fix the hole. Choose funds with microscopic expense ratios. Be intentional about how you pay for advice. Keep turnover low. Shelter returns in tax-advantaged accounts when you can. Simple moves, big difference. I've spent a decade watching two kinds of investors, the ones who hunt for magic and the ones who respect arithmetic. The hunters have great stories. The arithmetic people have great outcomes. Fees aren't exciting, but they are the rare thing in finance that's both knowable and controllable. Make them tiny and let time do the loud part. This isn't about being cheap. It's about being effective. Keep costs microscopic, keep your plan simple, keep contributing, and let compounding keep score.